this is something that I love to do, guys. You can kind of strategize and come up with an idea long before you ever put a penny into the stock market. You can know exactly what you're going to, what your goals are going to be, how much you can put in there. Again, budgeting wise, you can say, okay, well, I have, 100, 200, 300, 500, whatever it may be to put into the stock market per month. And it is really consistency, not only the strategy of planning this out, but it is also the consistency is really the big thing that is going to help you win. Because when you think about it, bigger picture, dollar cost averaging. So if the stock market is slowly going down and you buy a stock at $10, you buy a stock at $9.50, you buy the same stock at $9, $8.50, $8, you're essentially averaging the cost of those losses. You're not buying it at the very bottom, but you're also not buying it at the very top. The same is true when the stock is increasing in value. So when it is going up in value, as you continue to do purchases on a consistent basis, for me, myself, it is every 2 weeks. Every 2 weeks, I do allocate X amount of dollars into the stock market. I do put it into the S&P 500 because the S&P 500 is a complete portfolio and ETF of the 500 largest companies in America. The portfolio works pretty good. Even if you look at the performance over the last 10 years, pretty solid performance overall. The stock market yields roughly 8 to 10% is what people say. I say more on the conservative, probably the 6 to 8 side. That way, you're getting a 6 to 8% return. But again, it has to be a time frame that works with you, and also knowing your risk. This is probably one of the big things that I think a lot of people underestimate. When you look at the stock market, when you look at bonds, when you look at CDs, you have a absolute incredible amount of power out there. Do your research, guys. Hop online, check out channels. Be careful where you get your information from. Definitely, you want to make sure that it's good. Everybody will say, oh, we'll invest in this one single stock. Me personally, again, I do not pick single stocks. I pick pools of stocks. I pick ETFs. I'm not going to go out there and buy some of Google, buy some of Apple, buy some of Verizon. I hedge my bets and go with a bunch of stocks within a portfolio like the S&P 500, because even if you do have a couple stocks in there that do fail or underperform, the chances are the majority of them are going to be doing very, very well. Now, I know there are a lot of people who, again, do not want to lose anything, that absolutely want zero risk. That is when you look at your banking and financial institution CDs. You can look at bonds. Bonds do have somewhat of a little bit of a risk, but most of the bonds, depending on where you buy them, are backed by the United States government. You just have to be careful when you get into corporate bonds, municipality bonds. There is a risk that they could be defaulted on, and that is why bonds usually pay a little bit more. And again, a lot of people do like the principal guaranteed. Another thing we talk about, guys, is diversification. Now, when you look at long-term investing, diversifying your assets makes a big, big difference. Like I said before, when you look at the stock market in its entirety and you look at all of the different sectors of the stock market, you have your large caps, you have your mid caps, you have your small caps, you have your growth stocks, you have your value stocks, you have your penny stocks, you have mutual funds, you have ETFs. There is so much out there that you can actually go into. The diversification, again, do your research online, guys. Make sure you know exactly what is going to work for you. Large companies, large cap stocks or large company stocks are $10 billion or more. So again, when you look at the S&P 500, it is the 500 largest companies in the United States, which is the reason why I do like investing in that. In addition, personally, I do the Vanguard, the VUG, which I believe is the high yield. There's three that I actually invest in. One is that S&P 500 fund, which is essentially, a lot of people say, is the stock market itself. When you do the VOO with the Vanguard fund, I do a high yield dividend ETF, which again holds a bunch of different companies that pay dividend. And it's interesting right now because the dividends are still paying very well. And a lot of people have moved a lot of funds from the market, from the crypto markets, from a lot of different places into these dividend paying portfolios. I know Charles Schwab has a couple of good ones. Vanguard has a couple good ones. SCHD is one that I do have for my children. Again, long term, when I'm thinking 10, 15, 20 years, that is where I put some funds. That way it can build up, and we do have a lot of time to really get a lot of growth and a lot of building and a lot of income from those dividend stocks. Now, mid cap is between the 2 billion and the 10 billion mark, and then small cap follows anything that is below $2 billion. Now, in addition, guys, there's a couple out there, the Russell 2000, the Russell 3000. There are a lot of different ETFs that kind of bundle everything together that include a lot more than just the S&P 500. So where the S&P 500 takes the 500 largest stocks, the Russell 2000 takes the 2000 largest stocks, and then also the Russell 3000 does the same, where it does take a big pool of 3,000 stocks. Now, a couple other things, minding the cost of investing, guys, fund expense ratios and the advisory fees. This is one of the big parts where I really get down about. When you buy these ETFs, when you buy these funds, there is an expense ratio, and of course you're going to have to pay the expense ratio, guys. It is the cost of investing. That is it, guys. When you look at fees versus fines, it is kind of a fine line. It's actually one of the motivational speakers that I follow over on YouTube always talks about fun or fees and fines, and honestly, it is a fee. It is something you have to pay to invest in the stock market. Now, when it comes to advisory fees, this is where it gets a little bit sticky, because a majority of things you can do on your own nowadays. I know a financial advisor for guidance, but a lot of times they'll take 1 to 2% of a portfolio every single year. When you looked at that, 5 years, 10 years, 15 years, 20%, 20 years down the road, that is a lot. Depending on what you have invested, guys, financial advisory fees can eat up an incredible amount of returns that you're not seeing because of the financial advisors. But again, you have someone dedicated to managing your money. Now, with that being said, guys, I use M1 Finance. I have a link down below. It is such an incredible tool that I use for all of my investments. They have pies set up in there that are kind of like a financial advisor, but it gives you what you should invest in. Again, not financial advice. I rely on financial experts as well. Robo advisors will charge usually 0% or a very small percent. So again, when you're looking over the horizon of 5, 10, 20 years, it is going to make a really big difference when you're looking at the impact. Consider you invest $100,000 over 20 years. Let's say it gets you a 4% return. You pay 1% in fees. That is right, guys. Meaning you would lower the investment by almost $40,000, because what you would have earned, a majority of it would have gone to fees. A lot of it would have went to fees. If you're making 4%, they're taking 1%. You'd have almost $30,000 less. That is right, in fees over the course of that 20 years, which is incredible. Now, the final thing that I want to say, guys, is review your strategy regularly. You always want to monitor it. One thing that I've always noticed is a lot of people will put money into a 401k plan. They will never look at it. They will never monitor it. They will never do literally nothing with it. Very often, a lot of people do that. They kind of leave it right aside. But when you invest your own money, you look at it every day. You look at it 5 times a day. You look at it 10 times a day. Guys, this is a long-term strategy. And again, you really have to stick to the strategy of the 5, 10, 15, 20 years, depending on what the time frame you set. I actually use sticky notes for what we're investing on a regular basis, the time frame that we're having it, and also looking kind of at the track record. It's something that I do want to put into certain funds. Kind of know that it's managed, and it's managed well with what I have it invested in. Review it on a regular basis. Make sure that there's no real big changes to the companies that I have my stocks in. And that is, again, why I do ETFs, guys. For me, it makes sense. That way I'm not invested in just individual stocks, which is what I want. All right, guys, that'll do it for today's video. Before we conclude, if you haven't subscribed to the channel, guys, now is your time. Go ahead and subscribe if you made it to the end of the video. And as always, thank you guys for watching.